Welcome to Real Estate is Taxing, where we talk about all things real estate tax and break down complex concepts into understandable, entertaining tax topics. My name is Natalie Colati. I'm your host, and I am so excited that you've decided to join me. Hello, everyone. Welcome to today's episode. Over the last several years, I have noticed that whether it is online or with friends or in social groups, it seems a lot of people hold the same misconceptions about things related to taxes. So today's episode, we are going to go through some of what I consider the most common tax myths. So we are tackling the top 10 on my list, starting with number 1. It's a little bit more of a pet peeve for people in tax than it is an actual problem, but I'm going to put it out there anyway. First item on the list, people using the term tax return and tax refund interchangeably. These are not the same thing. Your tax return is the actual form that you complete and submit every year. For most people, that is your 1040. A tax refund is what you receive if you get money back because you paid in too much tax during the year. I've heard multiple times where people will say that they are waiting on their tax return, meaning their direct deposit refund after filing. That is not what you are waiting on. The return is the actual submitted forms. The refund is if you're receiving money back. I know it's petty, but tax professionals out there listening are absolutely shaking their heads. Number 2 on the list of common misconceptions related to taxes is the idea that someone needs to have a license to prepare tax return. They absolutely do not. There are 2 very common licenses that you'll run into related to tax. This is going to be the Enrolled Agent License, or EA, or your CPA license, or Certified Public Accountant. The EA credential is a federal credential that is backed by the IRS, and it is typically someone who specializes in tax or tax representation, representing taxpayers before the IRS. It requires passing a 3-part exam that is all on different types of tax. A CPA, or Certified Public Accountant, is someone who has specialized in accounting and may or may not work in tax. It typically requires a 5-year degree, experience, and then it has a 4-part exam, of which only one of the 4 is related to income tax. Either one of these licenses means that you are working with someone who does hold a credential that does hold them accountable to some level of responsibility. However, neither of these are required for someone to prepare taxes. To start doing taxes, someone basically just needs a PTIN, which is an identifier from the IRS, and to apply to be able to electronically submit tax returns. If you have those 2 things, you do not actually need to pass any kind of test or credential or license or school to be able to do taxes. So if you are a taxpayer listening and you are looking for a new tax professional, take a look at their history, look at if they went to school for something, find out if they do hold any kind of credential, because there are a lot of practitioners who are uncredentialed. I actually was before I got my EA license. Before I got my license, I had gone to school for 5 years and worked in public accounting for several years. There are people who literally last week worked at Kohl's and this week decided to do taxes as a side hustle. So check their background, see if they have a credential, because a common misconception is that you need a license to do taxes, and unfortunately, you do not. Now that we've got those items out of the way, let's move on to some more technical tax items that there are often misconceptions about. The first one on my list is a topic near and dear to my heart, the 121 exclusion. Misconception number 3 is people think that the only requirement to sell a primary home tax-free is that you have lived in it 2 out of the most recent 5 years. This leads to multiple times a week people being advised that if they have a rental property that they've owned for years and years, that all they have to do is move into it for a couple years and then they will be able to sell it tax-free. That is absolutely not the case. Specifically in Code Section 121, it dictates out the definition of what non-qualified use is. And this is any time when the property was used for a use other than as your qualified primary residence. There's an exception if there's a limited amount of rental use after you most recently lived in it. But if there was rental use prior to the time that you used this property as a primary residence, those years will be non-qualified use, and the gain related to those years will be taxable, even if you live in the house for 2 out of the most recent 5 years. So tax myth number 3 is that you can move into a rental property, and as long as you live in it for 2 years, you can sell it absolutely tax-free. That is incorrect. Tax myth number 4, this is one that I am so passionate about, I have it on a t-shirt. Tax myth number 4 is that an LLC provides you with tax savings, and this is absolutely not the case. So an LLC is a legal entity. It does not exist for tax purposes. If all you have is a single member LLC, you set up an LLC where only you are the owner of it, it is completely disregarded for federal tax purposes. This means that whether you do or do not have that LLC, your taxes are reported exactly the same way, and you are entitled to exactly the same write-offs, benefits, deductions, anything else, whether you have an LLC or you do not. Now, there are some exceptions to this. You can have an LLC elect to be taxed as an S-corp. That could have an impact on taxes. Or if you had more than one person on an LLC and a partnership is created, that has some options to impact taxes. But as its core, just creating an LLC does nothing tax-wise. I'm going to say this again. An LLC does not equal tax savings. This is misconception number 4, incredibly widespread. You do not need an LLC to have a business, nor does having an LLC create a non-existent business. So also creating an LLC does not mean you can now magically write off all kinds of personal expenses. None of that is true. An LLC is merely there to separate yourself from your assets or your business from a legal point of view. 0 tax benefits to an LLC. Common tax misconception number 5. This is one that is unfortunately reinforced by some tax professionals who have large followings on social media and YouTube channels. But tax myth number 5 is that if you employ your kids to work in your business, because their income will likely be non-taxable to them, as long as it's kept under the standard exclusion, as long as it's kept under the standard deduction, that you as a business do not need to issue them a W-2 or file any kind of tax returns to report their employment. This is absolutely incorrect. The nature of if someone's income is going to be taxed as an employee in no way removes your requirements as an employer to still file the required quarterly reports, annual reports, W-2s, the same way as you would for any other employee who may or may not have taxable income from your company. Just because you know that your kids will not need to take that form and use it to file their own tax return does not mean that you as an employer no longer have the obligation to submit the filings and record everything correctly on your part. Additionally, one of the secondary benefits to employing your kids and having them work for your business is the idea of funding a Roth IRA for them at a young age. A Roth IRA, or most retirement accounts, you would need to prove having earned income. It is going to be pretty hard for a child to prove earned income if they did not have to file a tax return and additionally have no type of proof of their employment. So in any situation, even if your children do not need to file a tax return as a result of their W-2 income from your business as the parent, you as the parent operating a business still have to report the payroll for your employees no matter what. especially if those kids are going to fund an IRA, you absolutely want to have that proof and make sure it is done correctly. So, tax myth number 5 is that you do not need to W-2 your kids if they work for you. That's incorrect. Additionally, please do not 1099 your kids if they work for you. In that case, any earnings over $400 requires the filing of a tax return versus the much higher amount of the standard deduction if they're paid as a W-2 employee. Plus, a child is very unlikely to be an independent contractor. Being paid on a 1099 implies that you, as an independent contractor, are doing that same job for more than one person, or you're in control of your own business, your hours, what to do. Most 7-year-olds aren't doing that. So, again, myth number 5, you do not need to W-2 your kids who work for you. That is incorrect. It is completely valid to employ your kids in your business. You still need to file all of the standard employment forms, W-2s, quarterly reports, annual reports, etc. Common tax myth number 6. Tax myth number 6 is something that I see people doing a ton of overly complicated planning around for absolutely no reason. This is the idea that the $18,000 annual gift tax limit means that if you give a gift of any more than that during the year, it will create a taxable event, and this is untrue. The annual gift tax limit is just a limit for when you need to file a tax return. If you gift more than $18,000 during the year, you need to file a gift tax return. That's just for tracking purposes. It does not generate any tax. The only time tax begins to be owed on gifts is once someone reaches the lifetime gift limit, which right now is over $13 million. So that $18,000 a year amount just keeps track of how much the lifetime total is, tracking the amounts that go into that piggy bank. And only if they hit that $13 million lifetime limit do the gifts start creating a taxable event. So lots of people I see doing lots of planning for splitting gifts between years, splitting them between taxpayer and spouse, doing all kinds of things because they believe they're going to pay tax if they gift their children some money to buy a house or whatever they're going to do. That's simply not the case. The annual gift tax limit is only a limit that if you go above it, you have to submit a form. You more than likely will not need to pay tax unless you've also gifted millions and millions of dollars worth of stuff. Tax myth number 7 is that if you receive a bonus through your job, it is taxed at a higher rate. And this is simply not the case. When you receive a paycheck, whether it is standard wages or it includes a bonus, any amount of tax that is held from that is withholding. It's not an actual amount of tax you're paying at that point. It's an estimate. When you receive a bonus as part of your W-2 income, it's just always going to be withheld at a higher rate. The IRS considers this supplemental wages, and it is going to, by default, set to withhold at a 22% rate against that amount. What this means is that if at the end of the year, your effective tax rate ends up being 10%, but on those amounts of income, there was 22% withheld, it means that they were holding more than what you owed, and you will more likely than not receive a refund at the end of the year. So the amount of federal income tax that is withheld from all of your paychecks throughout the year does not equate to the amount of tax you're paying. I know this sounds counterintuitive. It's like if you were trying to save for a new car and you knew that it was going to cost about $10,000. So you start putting aside $1,000 a month for 10 months. At the end of the 10 months, you go to buy the car, and it actually only costs $8,000. $8,000 is the amount you actually pay, and you would get a refund, or you would have this $2,000 left over. The same thing is happening here. They're estimating how much your tax should be at the end of the year, and they're holding X amount per paycheck. And then at the end of the year, when you put everything on your tax return and it calculates your actual amount of tax owed, you get a refund if too much has been withheld. So in the case of a bonus, it's not that you're actually taxed higher on that income. They're just holding more of it back for taxes because it is treated differently. So you're not actually paying more. You'll get it back at the end of the year. It does suck that you have less at the time, but just know that your bonus is not actually taxed higher. They're just holding a little more of it. Common tax misconception number 8 is how the 0% capital gains tax rate works. So long-term capital gains currently have 3 different rates: 0%, 15%, and 20%. That 0% rate applies to your income, and the bracket for that is about $47,000 if you're single, up to $94,000 if you're married, where you can get that 0% rate on capital gains. The misconception here comes into play when people think that to receive that 0% rate, the total capital gain needs to be under one of those amounts. This is not the case. That $47,000 amount, or 94-ish if you're married, your total income for the year, total income from all taxable sources, not just the gain, and including the gain, needs to be under that limit. So if in a taxable year you have a capital gain of $40,000, but your W-2 income is $100,000, that capital gain will not be at 0%, because when it is combined with your other income, you are well above that limit for the 0% gain rate. If during a year you had a capital gain of $20,000 and W-2 income of $20,000, you're single, your total income is under $47,000, everything, then that capital gain will be taxed at 0%. So common misconception number 8 is that the 0% capital gains rate, or really any capital gains rate, that the bracket is determined based on the total amount of gain, and that's not true. The cutoff for the brackets is based on the total amount of all income, and then the correlating percentage rate is what you pay on the capital gain. A little bit confusing, but better to know now than to think something will be taxed at 0% and face a nasty surprise later. Common tax myth number 9 is that because a 1099 is not required to be filed for someone unless they're paid more than $600, people think that the flip side of this is that if they've earned less than $600 doing some kind of self-employed work, and so they will not receive a 1099, that income is not taxable. This is not the case. Just because you didn't meet the required threshold for someone to have to send you a form does not mean that the income is not taxable to you. If you do work for 5 different companies, doing graphic design during the year, and they each pay you between $400 and $500, but you received no 1099s because no one person paid you more than $600, you still have to report all of that income, even though they did not have a requirement to send you a form. So all earned income is taxable, whether you receive a form stating it or not. So even if you have self-employment income and it's under $600, you still have to legally report that income as taxable income. And if you have self-employment income that is any more than $400, even if that is your only income for the year, you now also have a legal obligation to file a tax return. Normally, you don't have to if your income is under the standard deduction, but if you have more than $400 of self-employment income, you now have to submit a tax return. So common misconception number 9 is that income below the 1099 threshold is not taxable to the recipient, and this is incorrect. You are responsible to report all of your self-employment income, regardless of if you receive any 1099s for it. And the final item on our list, number 10 for common tax misconceptions. Number 10, if you move into a higher tax bracket, all of your income is now taxed at that higher rate. This is something I've seen very poorly misinterpreted, where people will advise against taking a promotion or try to advise against getting a bonus, because if it moves you into that next tax bracket, you're actually going to pay so much because of the difference that you'll end up making less money. This is not how tax brackets work. If you move from one tax bracket into the next, only the amount of income that is within that next bracket is taxed at that higher rate. For 2024, for a single taxpayer, the 10% bracket goes to $11,600. The 12% bracket kicks in at $11,601 up to $47,150. If during 2024 you earned $11,500, that would all be taxed at 10%. If you ended up earning $12,000, only the $400 that is now up into that next 12% bracket would be taxed at the 12% rate. Your entire $12,000 does not get taxed at that higher rate. Only the amount of income that crosses over into that next bucket gets taxed at that higher rate. So if you are still listening, thank you for hanging on till the end. And as I mentioned at the beginning, I think this is a good episode to share with people you know, because I'm guessing that you or someone you know or someone you have spoken to has made one of these mistakes or is about to, and maybe this episode can help prevent it. These are incredibly common misconceptions that I see over and over again. So I'm just trying to get this information out there and help as many people as possible clear up these misunderstandings. As always, if you found value from this episode, I would love if you shared, liked, subscribed, and I will talk to all of you next week.